네, 안녕하세요 여러분. 메이저쉬프트입니다. 자, 제가 이틀 전에 나온 캐시 우드의 월간 보고서 인더노우를 봤는데요. 사실 맨 처음엔 번역할 생각이 전혀 없었습니다. 근데 보고 나서 굉장히 파워풀한 내용들이 많고 꼭 숙지하셔야 될 부분도 많아서 우리 구독자님들께 공유를 해야겠다고 마음을 먹었습니다. 생각보다 내용이 난이도가 있어서 쉽지는 않았는데요. 질문이 있으시면 타임스탬프 찍어서 댓글에 달아주시면 성심껏 답변해 드리겠습니다. 이틀 동안 하루 종일 고생해서 번역한 거니까 꼭 끝까지 봐주시고요. 구독, 좋아요 부탁드립니다.
Hello, everyone. What a crazy week or two we've had here. So I'm breaking our tradition of doing a YouTube video on Employment Day and doing it midway through. We want to be there for our clients, and we want to share our point of view. We do have a point of view on what's going on. Both economically and market-wise. So as usual, we'll go through monetary policy, fiscal policy, some economic indicators, market indicators, and then we'll go into a lot of worries that the market's having right now. The impact of rising rates, the impact of Treasury Secretary's point of view on the crypto markets, Bitcoin in particular. We'll talk about inflation versus deflation. And finally, a word about the financial system generally. And then we'll have a final word on innovation, although it will be shorter today because there's so much going on that we want to address. So on monetary policy, pretty easy. Still with Fed Chairman Powell's testimony this week in front of Congress, we see that the Fed is nothing but supportive. And we see M2 growth still up in the mid-20s, very rapid rate of growth. So very supportive monetary policy. And the chairman emphasized once again that they're focused on two things: full employment, and we are far away from that. And then inflation above 2% and consistently above 2% on a year-over-year basis. We are not there yet. We're in the 1.5% to 2% range. So nothing right now suggests that the Fed is going to tighten. And we see other indicators perhaps calling for some changes at the Fed in terms of tightening up monetary policy. We see commodity prices really moving up very rapidly, especially copper, and especially copper relative to gold. So copper is the commodity with the PhD, as many people often say, and gold is more of the safe haven or inflation hedge. So to see copper going up that rapidly against gold suggests there are animal spirits out there. The dollar is going down. Housing prices are moving up at a double-digit rate, which is pretty astonishing. We've seen very strong asset market prices when it comes to stocks generally. We're still up for the year, even after the recent turmoil. And of course, we've seen action in the cryptocurrency space, pretty dramatic action. And yet the Fed is not responding to any of those, not yet at least. There are some indications in the market, because the market actually does lead the Fed, that the Fed will respond sooner than most believe, but we'll get into that when we talk about markets. On fiscal policy, well, thanks to budget reconciliation, we're probably going to get a package. It could come today, may already have come, in the $1.7 to $1.9 trillion range, so $1.7 to $1.9 trillion. That's pretty astonishing. It does not include the $15 minimum wage, which was originally in the bill, although that may be added to what looks like a $3 to $4 trillion infrastructure bill brewing. So think about that. Almost $2 trillion now, and then another 3 to 4 trillion on the way. Now, anyone who has read about guns and butter in the 60s, that was during the Kennedy and Johnson regimes, knows that we will have to pay for this in some way, shape, or form. We would like to think that the economy will grow its way out and that innovation will be a big part of the solution. But there are a lot of other investors out there who are very worried about leverage in the system. And we'll get into that as well. You know, we've just seen the $600 billion. This is not even part of this $1.9 trillion package. We've seen $600 billion in stimulus money making its way into the system. We saw that in today's personal income report. So disposable personal income was up 11.5% month to month. That's not year over year, that's month to month. If you annualize it, it's up by much more than 100% annualized. Pretty provocative. Spending was up 2.4% month to month again. Again, that's not annualized. So times 12, you know, almost 30%. And we're seeing the saving rate, because the income growth was so much stronger than the consumption growth. The saving rate went back to 20.5%. At the peak in the crisis, it was up at about 35%, but it had been coming down month by month. And we thought it was going to slip into the single digits. It did not. It has gone back to 20%. So again, the consumer has a lot of firepower here. And, you know, I would say the economy is on fire. I know we're not at full employment, and yet all of the leading indicators that we think are so important are on fire. And they have very high multipliers associated with them. And this is particularly true of housing. Just think about how much other spending a home purchase causes. And same with capital spending. Capital spending is really strong right now. It has been forced into action by the coronavirus, this move towards the digital everything, which has accelerated innovation beyond the rate at which we or most observers would have expected. So capital spending and housing have two of the highest multipliers in the economy, which means that a dollar spent causes more dollars to be spent, and again, a virtuous cycle. So we already think the economy is very strong. And we believe that the markets are now saying, okay, the economy is really strong. And what happened this week, and I think what shocked the equity markets to some extent, certainly the higher valuation part of the equity markets, was it looks like interest rates continue, long rates continue to go up. We got to 1.6% yesterday, I think, on the 10-year Treasury bond yield. Now, at the beginning of this year, many bond investors thought we'd have trouble getting through 1. Now it looks like we could go to 2 pretty easily. I will say, based on indicators, mostly if you look at short-term traders, there are measurements of their activity. There have been record shorts placed on the bond market. So they've been playing the momentum here as interest rates go up, prices go down. So traders have been shorting the bond market at record rates, and I looked back as far as 20 years. So we probably are in for a little bit of a pause here in the movement of rates going up for that reason alone. There's too much bearishness out there. We do know that 1.6% from 0.5% during the crisis. That is a monumental move in the bond market. The volatility in the bond market is beginning to outpace that in the equity market. And I think one reason for that is bonds have been in a bubble. And the search for yield became extreme. And so bond bubbles or any bubble, when it bursts, seems a little chaotic. And a tripling in the bond yield from the bottom has to feel like nothing bond investors have ever felt. What we're also seeing in the bond market is in the 2-year and 5-year range, the so-called belly of the curve, we're seeing those interest rates move up as well. Now, they had been held down for the most part because the Fed was saying, we're not going anywhere. We're not going anywhere. But now they're not being held down. And this could be the beginning of the market leading the Fed. Historically, that has been the case. The market has led the Fed. And what this could mean is the economy is so strong that the markets are now saying, okay, we don't need this quantitative easing. And the Fed is going to come to the same conclusion pretty quickly. So let's anticipate that move. So here we are. We think that move is on the way. Now, this also reminds me of the late 2016, early 2017. And at that time, the quantitative easing was on its way out, and the Fed was going to start raising interest rates. They had telegraphed that, and the market was very nervous. And I remember one of the reasons it was very nervous was after President Trump won the election, the odds of a cyclical burst increased because of his promise to cut taxes. And that's exactly what happened. But in the beginning, the equity market responded, was very nervous around this idea that interest rates would be going up. And what happened is when President Trump was elected, value stocks took off. Just like they're taking off now, responding to this idea that this economy is developing ahead of steam. So the value stocks have taken off. And in fact, if you look year to date, I think financial stocks are up 27%. And energy stocks are up 27%. Financial stocks are up about 11%. I think technology stocks, if I'm not mistaken, are up basically 1%. And healthcare, which is another area innovation strategies are exposed, that's actually down. So traditional value stocks are having a nice run here. And how do we feel about that? We feel really good about that. Just like we did in 2016, the market was up, value up even more, and growth strategies like ours were down. They were actually in negative territory back then. And I remember saying at the time, I think this is great. I think it's great because the bull market is broadening out to other sectors. And that can only be a good thing for us. What would be very negative for innovation-based strategies is if the market continued to narrow so that only innovation strategies worked. because that's what happened during the tech and telecom bubble. And we all know how that ended. There was too much capital chasing too few opportunities back then, too soon. The costs of the new technologies and the technologies themselves, the costs were too high and the technologies themselves were not ready. But the seeds for innovation, the innovation platforms that are moving into exponential growth trajectories right now, they were all planted back then. So I actually like the fear that we have experienced. I like it, and mostly because I don't think it'll last. But I'm happy that there's a reality check in terms of the speculative moves that have taken place within the innovation space. Now, what happened after the fourth quarter of 16, after the market had broadened out, was 2017 was a fantastic year for the equity market generally, both cyclical value and growth. I believe we're moving into the same kind of environment. Now, let's talk about the worries in the market. Well, I'll talk about crypto first, since Treasury Secretary Janet Yellen, I think twice this week, or maybe it was in the last 2 weeks, has gone out of her way, maybe in an answer to questions, I don't know, but has gone out of her way to telegraph how speculative Bitcoin is, and how it's not environmentally friendly or sustainable, and how it helps illicit activity or encourages and so forth. I'm not quite sure why she's saying this. All I know is that she doesn't understand the crypto space. And I say this with all due respect. I just don't think it is what she does. She's responding to a movement in price, that I understand, which has been very rapid. Think about it. I think up fivefold since the end of the third quarter. That's pretty extreme. So I can understand her saying that. As far as the environment, I encourage you to look up Yassine El-Mandra's white paper on our website, arc-invest.com. He addressed this environmental issue. And if you compare the energy use of Bitcoin in particular, compared to the energy it would take to mine gold, Bitcoin is digital gold, it's a fraction of it. And then if you want to think about it a little bit more broadly, because of course the Bitcoin blockchain and other blockchains are going to enable much more rapid settlement of trades and transactions than the traditional financial institution, say 10 minutes as opposed to a week or a few days. Think about the energy consumption of the traditional financial world, and you'll see in that chart what Bitcoin is using in terms of energy right now, which is mostly renewable, by the way, hydroelectric and other renewables, is, again, fraction. As far as criminal activity, I mean, I'll just reflect on a conversation that I had at a conference with an FBI agent very early on in my understanding or learning about Bitcoin. And he said, this is the best thing that ever happened to us. What does the FBI do? It's filled with cryptographers who are able to break codes and figure out illicit activity. And they have been able to. One of the reasons is that the Bitcoin blockchain is so transparent by IP address. So pattern recognition, cryptography, an interesting way to think about it. And And as far as speculative, sure, it's had a very big move recently, and I would say some of the recent buyers might have been influenced by other people and not a real understanding of what is going on here. But as I did say this week, and I saw it in a report or in a headline, I did say we, and go through Yassine's paper, we can see trillions of dollars in use cases for Bitcoin. And I think the most important thing that we as investors need to do is be very supportive of those who are evolving this ecosystem. And so we at ARC are thinking about ways to help the community in terms of Bitcoin developers to secure the network. It is right now the most secure blockchain technology out there. And so for very high value transaction, think $1 million transaction, it does take 10 minutes, and that seems to be a complaint, and it is a complaint relative to other blockchains that involve smart contracts that are instantaneously settled. But this is the most secure network, and one reason is that 10 minutes. And if the cost is, I don't know, $10, and I'm not quite sure what the cost is, but compared to the cost to transfer $1 million through traditional financial systems, no, there is no comparison. So our confidence in Bitcoin and the Bitcoin blockchain has continued to grow over the years, as I think we've stated very often. Another worry is the impact of interest rates on PE ratios. And that is why high multiple stocks have been hit hard here. Well, one of the things that has puzzled me over the last 10 to 20 years is as interest rates were falling, and I believe in the tech and telecom bubble, they were starting from, this is a 10-year treasury, 6-7%. As they've come down, and we bottomed at 0.5% during the coronavirus. As they've come down, what was interesting to me was PE ratios, which should have gone up because of the discounting of future cash flows and these lower and lower discount rates. They seem to always top out in the 20 to 25 range. Now, that's an earnings yield. If you do E over P, you've got an earnings yield in the 4 to 5% range, right? And what this tells us is the equity market has never incorporated 1% or 2% or even 3% into the valuation. If we are right and the nominal growth in the economy is not going to be 4 to 5%, which we believe is the normalized rate that the market has been baking in. So 1 over 4% would be a 25 multiple. Again, just quick and dirty way to think about this. Or 1 over 5% equals 20%. I mean 20 times. We've never been able to get through that. But what if the normalized growth rate is actually 2 to 3%? And you do that same analysis, there should be serious valuation support, and especially for companies that are able to grow very rapidly during the next few years. Now, we don't think anyone will believe what I just said until it is tested and proven. So what that means, and what we believe could happen here, is the 10-year treasury yield could move to that, or needs to move to that 3%, and we think it will get there at some point. It will take a while, but needs to get there and then maybe fail because of this notion that nominal growth in the economy is closer to the 2 to 3% range. Now, why would that be? So we think there are major deflationary forces evolving in the global economy. And they're fighting this notion that all of this monetary policy ease throughout the world is going to ignite inflation. Well, we believe that point of view is going to be in a dueling match with the two deflationary forces. One is good deflation and one is bad deflation. So the good deflation has to do with technologically enabled innovation. It is deflationary by nature. It rides down cost curves, gains efficiency, gains productivity. And as we've told you before, in the electric vehicle space, for example, that deflation rate is 28% for every cumulative doubling in the number of units produced. And we're only at 2.2 million units of EVs right now. So think about that, 28% for every cumulative, and it's not going to take long to double that 2.2 million units. And in the DNA sequencing space, it's 40% for every cumulative doubling. And we're at a very low base there as well. But those low bases are going to move up pretty quickly. We think electric vehicle sales will move from 2.2 million to 40 million, almost a 20-fold increase in the next 5 years. But they're at a low base right now, and they will only begin to impact economic statistics as they scale during the next few years. In the meantime, what's going to happen? This disruptive innovation is going to cause creative destruction in the traditional world order. And it's not just electric vehicles and DNA sequencing, it's robotics, artificial intelligence, blockchain technology. There is so much innovation taking place right now. And I don't think that investors appreciate how these S-curves are feeding one another as these innovations converge. The best example of that, we believe, will be autonomous taxi networks, the convergence of robots. Autonomous vehicles are robots. Energy storage, they will be electric. That's going to be the cheapest form of transportation. And artificial intelligence. Those three S-curves converging. We were talking about this at our brainstorm today, and I was trying to say, how can we capture this so people really understand it? You know, this combinatorial or this multiplicative, S-curves feeding one another. And someone on the brainstorm, a visitor, said, well, it could be like waves crashing in the ocean. Some ships will be elevated, others will sink. But the bottom line is the energy release associated with these waves intersecting with one another is powerful. And that's what we think is going to happen. It's going to take a while for us to see this in economic statistics because the economic statistics are so grounded in the industrial world and don't capture a lot of what's going on in the digital world. But they will as the revisions take place over time. So that's the good deflation, powerful deflationary forces. The bad deflation is associated with what I just mentioned. The disintermediation and disruption to the traditional world order is going to put a lot of companies at risk. Now, a lot of companies who thought they were steady eddies, and nothing really would ever change, whether it's in the financial services sector or the auto and auto-related sector, maybe the rail sector, almost any company associated with the internal combustion engine and suppliers around. I mean, this is a massive part. These are massive parts of the economy. Many of those companies have, because of shareholder, maybe the short-sightedness of shareholders, have adopted short-term time horizons themselves and catered to these shareholders. They have consistently leveraged up to buy back their shares and pay dividends. Now, we're seeing the result in formerly blue chip stocks. GE is one, IBM is another. There are going to be many more of these. Many are highly leveraged because they didn't understand how quickly the world was going to evolve. In fact, their time horizon wasn't 5 or 10 years. It was 2 years or until the end of the CEO's term. What's going to happen now, we believe, is they are going to be forced to cut prices in order to service their debt. And so that's the bad deflation. And this is the deflation that Ray Dalio, Jeff Gundlach, and Howard Marks have focused investors on, and we believe that's right. So 2 forces of deflation, and then we have this question about money and how will it cause inflation. I don't know. And I would say these 2 deflationary forces are pretty powerful in the short term. They're going to cause a lot of confusion. And you've heard me use the word velocity before. I know it's somewhat esoteric. All it means is the rate at which money turns over. If there's a lot of confusion, especially in the traditional world order, the velocity of money will continue to fall. The reason that the monetary easing globally during the 2008 and 2009 meltdown and afterwards, the reason it never ignited inflation was this velocity. The money went up, but the rate at which it turned over per year in the economy slowed down as people held back. They were risk averse, concerned about their futures, concerned about their company's futures. I think that probably will continue as these dueling deflationary forces against all of the monetary ease. So those are some of our thoughts. I hope I've helped to clarify things. So I hope you all have a lovely weekend, and I guess I'll be talking on this channel again the first week in March. That might be, well, probably 2 weeks from now, the employment report. So hope you have a wonderful weekend. Thanks so much.